Hello, SOFI investors. What's going on? So, on Friday, the stock was down more than 6%. Paper hands are shaking, but we need to take a deep breath, step back from the short term noise, and ask the $1 million question. Is this stock offering a desperate move, or it is the ultimate calculated power play by a leadership team laser focused on the long term value? I'm going to show you why this latest tip is likely a massive gift positioning SOFI for a truly explosive 2026. First, let's talk about the bad news and let's not sugarcoat it. SOFI raised 1.5 billion by selling common stock, causing a short-term dilution of roughly 4 to 5% of your ownership. The market reaction, which saw the stock drop, was predictable and frankly justified. The timing felt awkward, coming right before the S&P announcement. But the biggest issue for many investors was perceived contradiction. Just week prior, CFO Chris stressed the company's strong capital positioning, referring to their previous raise as purely opportunistic. When you tell the market you are fine and then 24 hours later, you drop a bomb of dilution, trust takes a hit. The retail investors is right to feel frustrated. However, we have to remember the context of who is running this company, which brings us to the bull case, the incentive structure and management's track record. When accessing move like this, we must look at the management skin in the game. CEO Anthony Noto has a massive performance share unit, or PSU, incentives tied to specific stock price target at 35 and 45 per share in summer of 2026. Every share they issue today makes it harder to hit those targets. Noto wouldn't dilute himself and his team's massive potential payout unless he believed this money could generate a massive ROI for the business, far exceeding the small amount of dilution. In other words, he's taking one step back to take three giant leaps forward. And history is our guide here. When SOFI raised capital in the past, the stock saw a similar temporary dip, but that dip was quickly bought up and the stock propelled to new highs. This management team has a proven track record of using capital raised strategically to improve the long-term health of the business. So if the capital isn't for a desperate need, what is it for? I believe that it opens two bullish doors. First, debt neutralization, the most reasonable use and a huge benefit to shareholders, is tackling their convertible debt. SOFI has convertible notes due in 2026. The fine print on those notes means that once the stock price hit about $32, SOFI gets diluted. By using this newly raised cash to wipe out that debt now, they effectively remove $32 dilution cap. This moves clear the runway entirely, allowing the stock to fly past $32, $35, and $45 without any penalty or overhang. It's clean up the balance sheet, turning it into a complete fortress. Second important thing is the acquisition play. This is truly exciting prospect. This latest raise pushes SOFI's already strong capital ratio to around 25%. For a bank, high growth ambition holding 25% capital is incredibly inefficient. You have too much cash sitting on the sidelines. The only reason to hold this much firepower is if you have a massive target. This capital act as an acquisition war chest. Management has signaled they are always looking at high ROI opportunity. By securing the fund now, they can move aggressively and decisively to acquire a company that could instantly broaden their product offering, boost their technology, or expand their member base. An acquisition of that magnitude would immediately propel their business and send the stock price soaring, easily absorbing the short dilution. So get ready for it. With that said, thank you so much for being here. See you in the next one.